Welcome. It is great to be with you today. I'm excited to spend some time. I'm really excited to introduce you to our good friend Josh over at Neo Home Loans. And I promise today's time will be time well spent. As always, I'm Chris Brown, the CEO here at Tax Hive. We love these community events. Our goal every week is just to bring in people from our sphere of influence, our relationships, and just bring incredible content and information to all of our Tax Hive community. And today is going to be no different. I think this is Josh's first or maybe second webinar with us, but Josh isn't a stranger. He's actually been coming into our office for our Business Accelerator events and been training here in office. And the feedback we've gotten, Josh, is just through the roof. Everybody loves what you have to share, and I'm excited to share it with a wider audience today. Uh, Josh and his team at Neo Home Loans are such a critical piece that we found to kind of add to our repertoire here. And I want to explain to you why. As business owners, I'm just like all of you. We want to pay as little as we can in taxes. Sometimes when we do that, we create some issues with lending. And it creates a dynamic that we see clients wrestling with. Well, man, do I want to overpay on taxes because I've got this loan? And while Josh does a lot of traditional stuff, Josh does a ton of stuff to help people out just like us. He is a perfect fit for what we do and a perfect fit for our client base. And today he's going to spend some time helping us understand how money works, how loans work, and what some options are for people like you and I who maybe are really trying to maximize our tax savings, but we've got money coming through the front door and we want to use that to leverage it for our business, for a home, for different things. Josh has some incredible solutions. Today's not just about solutions, although it is that. It's a lot of great education too to help you understand how this works. So Josh, I'm so happy to introduce you to the rest of our crew here at Tax Hive. We've got a great group on today, and I highly anticipate Josh being kind of a normal contributor here on our Tax Hive community because what he has to share lines up so perfectly and is such a perfect solution for those of us that are entrepreneurs that play this game. So, Josh, I don't want to steal any more of your thunder. I'm going to turn it over to you and let you run with it. Thanks for taking the time today.
Thanks for the frame, Chris. And I kind of wished my wife was here as you were just saying all those wonderful things about me. So I'm glad to see this is being recorded. It's great to be here. Thank you, Tax Hive, for having me. And just a little bit of context. My primary business over the last 25 years has been serving entrepreneurs, self-employed folks, and especially self-employed folks that are trying to build passive income through real estate investing. My side hustle for the last 25 years has been as a real estate investor. So I, just like you, as self-employed, I file over 27 tax returns. That was last year. There'll be more this year. And I have a real estate portfolio that I've grown with my mother. We have a family office. We started investing together 20 years ago. And we now have a real estate portfolio that's valued in the 9-figure range. So everything that I am teaching you here today is not just through the lens of someone who writes mortgages, but through the lens of an investor that has been in this game for almost 3 decades. And I have the very unique vantage point of watching my trajectory through real estate investing, while simultaneously being able to help thousands of clients over the last 25 years overcome challenges, as Chris alluded to, with qualifying for mortgage financing when you have a great tax strategist like Tax Hive that is helping you get your adjusted gross income as low as possible so that you're not overpaying on taxes. And I'm also watching the strategies that I'm seeing the most sophisticated and successful investors employ in today's market. So this presentation, this is the first time I'm giving this presentation because it really came about because I'm watching these investor clients, I'm seeing what they're doing, I'm understanding why, and I'm thinking everybody needs to know how to do this. We need to democratize this information. So I'm glad there's so many participants here. Feel free to use the chat button. I hope at the end of this, there's enough time for some Q&A. If not, I'll give you a scheduling link so we can go deeper on your specific situation. All right, without further ado, I'm going to share my screen and great. And I'm going to assume you can see that, Chris, unless you tell me otherwise. The topic that I'm going to teach on today is how self-employed investors are buying rental properties and scaling their investment portfolio with zero money down and slashing their tax bills. It's really the trifecta. Now, most investors have been led to believe that you need a big down payment and you need taxable income on your tax returns to buy real estate. There's three common problems that self-employed investors face. Number one is legitimate tax write-offs lower your income and make it harder for you to qualify for conventional loans. In 2010, the Dodd-Frank Act came out, and that Dodd-Frank Act said it's actually illegal for a bank to make a mortgage loan without proving your ability to repay. And there were some significant unintended consequences of that legislation, especially to us self-employed investors, self-employed folks who our entire game is to get our taxable income as low as possible. So we're gonna show you how to solve for that problem. The second problem is, or the second misconception, I should say, is that down payment money must be new capital and it needs to be sourced and seasoned, meaning you have to bring new capital to the game to scale your real estate portfolio, and it needs to sit in your bank account for 60 days, what mortgage underwriters would say sourced and seasoned. And number three, the number three problem is that banks ignore our real estate equity and our true cash flow. You notice when you fill out a loan application, what are they mostly interested in? What's your after deduction income? How much money do you have in the bank and in your stock account? And many self-employed folks save for retirement and plan for retirement, not through traditional retirement accounts, but through real estate and passive income that's created from their portfolio. So if you've ever had those problems or you anticipate having those problems, you're in the right webinar, because that's exactly what we're going to solve for here today. So I'm going to teach you the self-employed investor blueprint. Number one, I'm going to show you how to use existing real estate equity to purchase new properties with zero money down, zero new fresh capital to the game. I'm going to teach you how to qualify for financing without tax returns, meaning even if you don't have tax returns, or if your tax returns show you took a loss, you can still qualify for these loans and scale your real estate portfolio. And number three, I'm going to give you some ideas on how to stop overpaying in taxes. Of course, TaxHive, they are the tax strategists. I'm just giving you some ideas, some things I'm doing in my portfolio, some things I'm watching the most sophisticated investors that we do mortgage loans for, and how they're using some of these covenants inside of the one big beautiful bill to drastically reduce their tax burden. Now, here's the good news. The good news is if you have owned real estate over the last 5 years, you have done spectacularly well. The national average of home appreciation in the United States over the last 5 years is almost 54%. If you live in the great state of Utah, it was 56%. If you were in Idaho, 63%. If you were in Montana, congratulations, your property went up by 70% over the last 5 years on average. So there's a ton of equity frozen behind the sheetrock of the homes that we already own. The question is, how do we get access to that capital without refinancing and paying off those low interest rate first mortgages that many of us have? And how do we speed up the velocity of money? How do we use that capital to scale our real estate portfolios, increase our cash flows, and make retirement something that we really look forward to? So the first thing that I'm going to teach you about here is credit lines on existing properties. So we don't need new money to scale a real estate portfolio. We just need access to the existing equity inside of our properties. So number one, I look at equity as capital. It's just capital that's frozen behind the sheetrock of our homes, and sometimes it's hard to get access to. It also is hard to get access to that capital if you don't want to refinance the 3% mortgage that you took out in 2020, 2021, or 2022. So we're going to teach you how to do that. Existing properties are leverage. What I've done throughout my real estate career to scale to a 9-figure portfolio, and what I'm watching the most successful investors that we serve, is they're using their existing properties as leverage to scale their portfolio growth, their real estate portfolio growth. And lastly, we're going to teach you how to access capital without paying off that existing first mortgage. So here's a little pop quiz. I would love for everybody to put the answer to this in the chat. I see Sonia's active in the chat already. Thank you very much. Which house appreciates faster? A $400,000 rental property appreciating at 5% per year that is A, free and clear, or B, has $300,000 in debt on it? Let me say the question again. The answers are either A or B. Which house appreciates faster? $400,000 house appreciating at 5% that's free and clear, or that has $300,000 in debt on it? I got Lisa answered. I got Lenny. Here we go. Trixie, Eric. All right. Yep. Eric, you got it. Lisa, you stole the show. It's the same. It is exactly the same. So think about it for a minute. Your appreciation is on the total value of the house. So I just showed you over the last 5 years, real estate prices in the nation are up about 50%. That's about 10% a year. Let's assume that over the next decade, we only see 5% appreciation. So on a $400,000 house, that means 5% appreciation is $20,000 in equity that you gain each year. And that is true whether you have zero mortgage indebtedness or whether you owe $300,000 or $400,000 on that home. The asset is still appreciating at the same rate. So thank you for playing, and congratulations to the savvy winners there, Sonia and Eric. Great job. All right. So here's how we access that equity that's frozen behind the sheetrocks of our homes. We use lines of credit, and many banks do not offer lines of credit on investment properties. They just offer lines of credit on primary residences or sometimes secondary homes, but oftentimes not on investment properties. So let me give you some ideas on products that are available that are out there. I'll go through this really quickly. So first of all, there's what's called the closed-end second mortgage. You leave the first mortgage alone. You do a fixed rate amortizing second mortgage. It can be 15 years, it can be 20 years, it can be up to 25 years, but it's just a second mortgage, and they call it closed end because you take the money once and then you pay it back over a fixed structure. You can access up to 95% of the value of the property in owner-occupied homes. Credit scores down to 660. You can access this type of loan through our programs. Full doc, meaning tax returns and what I call a full financial oscopy. You can also qualify based off bank statements. So let's say your tax returns show a big goose egg or not enough of a gain in order to qualify. No problem. We'll show 12 months worth of personal bank statements or 12 to 24 months of business bank statements, and we can use the deposits into your bank accounts, and we don't even ask you for the tax returns if they don't qualify. You can also use a P&L. You can use 1099 income. We have lots of ways to qualify self-employed folks without entering a tax return into the equation. And yes, this property is available to investment properties. It's a little bit of a lower loan to value. It's capped at 85%. This is a common option for accessing equity for down payment. So if you're going to use this capital as a down payment on a property and you're probably not going to pay it back very quick, you're going to keep that loan out for an extended period of time, this is a pretty good option. Another option is what's called the investment property HELOC, home equity line of credit. All of these options don't touch the existing first mortgage indebtedness you have on your property. You can leave that alone. You can access up to $750,000 on an investment property HELOC. You can get up to 80% of the equity of the home. What does that mean? Okay, I've got a $500,000 house. You owe $200,000, and that's at 3% interest. You never want to touch that mortgage. So you've got $300,000 of frozen equity inside that home behind the sheetrock. Well, 80% loan to value means you could borrow 80% of the 500,000. That'd be a $400,000 total exposure. You have a $200,000 first mortgage, which means you can get a second mortgage for $200,000. You can pull that out on a line of credit. The beautiful thing about a line of credit is you only pay interest when you draw the money. So if you pull the money out for a real estate flip, or maybe you're going to do a renovation, or maybe you're going to use it to buy a lot, and then you're going to refinance that asset or sell that home, then you can pay down the line of credit. Well, once the line of credit is paid down, you only pay equity on what is drawn. Kind of think of it like a credit card, if you will. Investment property eligible, yes. And this is the best use case is flexibility. It gives you the ability to draw money and pay it back and only pay interest when you have it out. You can also do a primary residence home equity line of credit. We call this the express loan. These loans can close in as little as 2 weeks. Oftentimes, we don't even need appraisals. You can get up to $500,000, 95% loan to value. You can do bank statements or full docs. So if sometimes the rate is a little bit better if you do the tax returns. And if your tax returns are, well into the green and you qualify, great, go for it. And this property does not allow investment properties. Last but not least, there's what's called our jumbo line of credit. This has the loan amount up to $5 million based on the property strength. So it's based upon the saleability of the property and how liquid it's determined that asset is. What the heck does that mean, Josh? Okay. I live in Park City, Utah. The median home price in Park City, Utah is about $3 million. So there's a lot of people who have $10 million houses here and small mortgage amounts. And this is a very liquid area, meaning that there's lots of sales in Park City proper. But if I go out to Midway, which is kind of a rural area, and you've got a house that's on 50 acres, they're not going to consider that there's not a lot of sale velocity going there. But if you've got a home that's in a very liquid market like Park City, like Brentwood, California, like San Diego, like Austin, Texas, like Miami, Florida, you get the point, then you can pull huge lines of credit against those properties. And this is great for scaling large portfolios and for advanced investors. And it's all based on the strength of the property. It's not contingent on the borrower's strength as much. In fact, we recently did one of these with a client that had like a 566 credit score, believe it or not, but they only needed 50% access to a $12 million home in a very liquid market. I think it was Southern California, like Brentwood or something like that. So there's just some ideas of how you can access and unfreeze the equity that's behind the sheetrock of your home. These credit lines provide you with the capital that you then need to go buy new investment properties or renovate your existing properties that you have, or build a new property, or buy a lot, or just perhaps make a strategic investment in your business. Maybe there's an opportunity in your business that if you could borrow at 6 or 7%, you could make 20% in your business. And this is a great way to free up that kind of capital. Now, great. Now we've freed up some capital. What do we do with that? How do we buy and scale real estate with a modern mortgage experience without tax returns? This is I'm going to teach you next how you scale your real estate portfolio if traditional banks say you don't qualify. This is what we call the entrepreneur home loan. This is funding built specifically for self-employed borrowers that have advanced tax strategies. And there's essentially 4 different programs I'll go over. A debt service coverage ratio loan. This is if you're buying an investment property, you don't want to show tax returns. We can actually use the future income from that property when you convert it into a rental property to offset the payment. Great option. Bank statement loan programs, I mentioned that before, no tax returns. We use either 12 or 24 months business or personal bank statements. We take the deposits. That's what we use for your income. You can do something called an asset depletion loan, where if you've got a bunch of liquidity, I had a gentleman who sold 13 car washes. He had paid off everything under the sun, moon, and stars, paid out all of his clients, paid out all of his taxes, had $7 million sitting at his bank. He applied for a $500,000 mortgage because he wanted to parlay that $7 million into cash flow positive properties. His bank declined him for a $400,000 loan when he had $7 million sitting in the bank. Why is that? He had no income. He just sold his baby, which was his car wash franchise. He just spent the last 13 years building. And the income that showed on his tax returns last year was now gone because he filed a final tax return. So this asset depletion loan can be a really powerful tool for self-employed folks, people that have exited, et cetera. And then, of course, 1099 and self-employed programs that don't require 2 years of tax returns. Many entrepreneurs will start businesses, close businesses, start another business. This business made money, that one lost money, and you're kind of shuffling the deck with the way that you have your cash flow, your different cash flow vehicles. These loans that we have access to do not require 2 years of tax returns, which is the conventional norm. So really, if we do kind of a comparison here, I'll give you another high-level overview of kind of how to look at this. Conventional loans, Fannie Mae, Freddie Mac, FHA, VA, that's about 97% of all mortgages that are written in the United States. These are the full tax returns, W-2s, paycheck stubs, full financial oscopy. You have to typically do 5% down. That's for owner occupied. For investment properties, it's 15% down. You're stuck to conforming loan limits. So depending on where you are in the country, you're going to have a loan limit you can't go over, and that varies by where you are in the country. But those loan limits are typically under $1 million, and it's best for W-2 employees or self-employed people that have very consistent and stable income without significant write-offs. That doesn't work for most entrepreneurs. So one of the programs we have is called an Entrepreneur Advantage program. Literally no tax returns. It's just based on the property. You're qualifying essentially based on the documentation of assets, credit, and your liquid reserves. 20% down, loan amounts up to $2 million, 1 to 4 units allowed. And this is great for borrowers with strong assets, credit, and reserves. The debt service coverage ratio loan I already went over. You're qualifying based on the rental property cash flow. Then there's the bank statement loans, which I talked about, 12 to 24 months worth of bank statements, loan amounts up to $4 million, debt to service coverage ratio go up to $5 million. And then there's that asset bank backed loan that I mentioned, up to $4 million. So what are the different interest rates with these various programs? Well, this was a couple of weeks ago, and I don't know if anybody's been watching the mortgage interest rate world, but things are getting a little funky out there. The job data is not that good. If you're watching the leading economic index indicator, that's been going down for like 36 months in a row. It never happened before without going into an economic recession. Those things have brought mortgage rates down because those things are deflationary, and it's inflation or deflation that drives mortgage interest rates. So mortgage rates have actually improved since I put this slide together, but it doesn't matter. Mortgage rates fluctuate every day. The point of me showing you this slide is a conventional loan on an investment property, when I pulled this up, was about 7.25. It's probably about 3/8 lower now, probably high 6s. Your debt service coverage ratio loan was actually a lower rate than the conventional loan. Your bank statement loan was lower than your conventional loan, and your asset bank-backed loan was lower than a conventional loan. So you shouldn't expect to pay hugely, inordinately higher interest rates for these programs, especially if it's investment property. Now, if you're comparing a 25% down owner-occupied conventional loan with a debt, well, you can't do debt service coverage ratio on an owner occupied because there's no rent to offset it. But if you're comparing that to a bank statement loan or an asset based loan, then you'd actually be better off going with conventional if you qualified. But for investors, It's a lot less headache. There's a lot less documentation, no financial oscopy, but you actually still get great interest rates. So don't let the fact that you don't tax rate qualify scare you away from building your real estate portfolio. All right. So that's how you acquire the new property, even if your tax returns don't qualify according to traditional banking institutions. Now, I want to talk to you about our buy before you sell program. This is such a valuable program that most traditional banks don't have. It takes so much stress out of the equation. In fact, I was at one of the business accelerator events 2 months ago. I think it was in November, maybe 3 months ago. And there was a lady there that said, we live in this giant 8,000 square foot home. Our 4 kids have moved away. We really want to downsize, but I can't bring myself to sell my home, figure out what I'm going to do with all my possessions, and then go buy another home. And I'm like, well, you don't have to. That's why that's why we came up with the buy before you sell program. This program enables you to buy the new home, with what's called a bridge loan. You're bridging the equity from your old home to your new home without selling the old home. It enables you to close fast. So it's very ideal for competitive or off-market deals. Let's say that you find the perfect home, but you haven't sold the investment property that you want to move into it, or you haven't sold your primary residence. It works both ways. No worries. You can close in just a couple of weeks with no money down, no cash out of your pocket, by using the equity in the departing residence. It gives you leverage to tap equity from your current holdings without selling. It gives you flexibility because you can use the funds for acquiring a home, rehabbing a home, or constructing a home. So get this, you can live in the home, use the equity from that home to buy the lot and build the home, then move into the new home, then you sell the old home. Super awesome solution for anybody that wants to transition and they would rather buy before they sell. And then, of course, it becomes very valuable when you're looking to improve or lease up a new property, and then you want to refinance that loan into traditional financing. Oftentimes, investors will find a home that needs to be renovated, it needs to be fixed, it needs to be rented out, and then it qualifies for like a debt service coverage ratio loan to refinance. So you don't even have to sell the departing residence, is what I'm saying. You could have a investment property that has a ton of equity in it. You can buy the new investment property, renovate the new investment property, rent the new investment property, refinance the new investment property, and then use those funds to pay off the loan that was in the original investment property. So tons of flexibility here, tons of variations. I'm sure people will have questions on this. We can try to get to it in Q&A, or we can schedule time to go one-on-one and run through analysis on this. So now we've gone over how do you get access to equity in your current real estate portfolio without paying off your low interest rate mortgages. How do you qualify for buying new properties without tax returns and without selling the existing home? Now I want to get you into what I call 4 essential tax strategies to consider. So, legal disclaimer, I am not a CPA, nor am I a tax attorney or tax advisor. The good folks at Tax Hive and over at API Law, they can help you with specific advice. I'm just a real estate investor, a student of the game, just like you, and I'm sharing what I believe is to be true based on my research for me in my situation. It may not be true for your situation. Check with your tax advisor and do your own research. But these are the things that I am doing myself, and I'm watching those sophisticated investors that we're helping take advantage of these tax strategies. All right. Number 1, accelerated depreciation. Number 2, Section 179 expensing. Number 3, R&D and innovation credits. Yes, even for real estate investors. And look at that. 1 2, 4. Leave it to a mortgage guy to not get the math right. All right, let's try that again. 1, 2, 3, and this should be 4. Opportunity zones and capital gain strategy. All right, let's jump in. Number 1, accelerated depreciation, also known as bonus depreciation. You essentially turn paper losses, i.e., depreciation, into real cash. You turn it into real cash because you lower your taxable income, which means you don't pay as much in taxes, which means you have more real cash. You're front loading depreciation. So when you front load that depreciation on an investment property, instead of spreading that depreciation over 27 and a half years for residential properties or 39 years for commercial properties, you can do this through a cost segregation study. In other words, you don't have to wait 27 years to get that depreciation on your next single family rental. You can pull a lot of that depreciation forward through what's called the cost segregation study, which I'll get into here in a minute. You can take advantage of what's called bonus depreciation, which is when you pull that depreciation forward into the first year you put that asset into service, meaning when you sign a lease and take your deposit and take your first month's rent. And it enables you to break down the property into shorter asset classifications. So when a cost segregation study is done, someone actually goes out to the property and they assess the property into different buckets. Is it 5-year property? Is it 7-year property? Is it 15-year property? Anything that is 5, 7, or 15-year property can be pulled forward, and you can take that depreciation the year you put the property into service. So instead of slowly deducting the building value, you carve out components of the building like appliances, flooring, electrical, landscaping, etc., and you depreciate them much faster, which accelerates your tax deductibility. Let's do a case study because I'm a visual person. So this is a scenario of someone buying a $400,000 rental property with a $100,000 renovation. So, and the first thing that the tax segregation study does is it's going to pull out the land because you can't depreciate land. The IRS doesn't say, the IRS says, hey, that air conditioning unit and your appliances and your flooring and your sheetrock and your roof, they all have life expectancy, and over a period of time, it'll go to zero. That's the depreciation schedule. But land, it's always going to have a value. So we got to take that out. So now you have a $320,000 building. You're going to do a $100,000 capital improvement renovation. So you have a total depreciable basis of $420,000 in this single family residence case study. Now, let's just make an estimate here that you do a cost segregation study and it breaks down your 5, 7, and 15-year property, and that's valued at about 40% of this $420,000 depreciable basis. And then 60% of the building is deemed to be 27 and a half year residential. Well, this 40% equals $168,000 of that's eligible for full bonus depreciation that you can pull forward to offset passive income and other, I'm going to get into this a little bit more, but you can pull it forward to offset income. And then you still have $252,000, which you can depreciate slowly over that 27 and a half years. Now, the One Big Beautiful Bill Act brought back or restored this 100% bonus depreciation, which means you can take this write-off in the very first year. As long as you placed that property in service after January 19th, 2025. So you could actually do this if you bought a property after January 19th, 2025, you could actually do what I'm talking about on that property as well and have all of these gains. So how does this work? What is the actual tax savings to you? All right, let's go through it. So we've got $168,000 year one that we can take as bonus depreciation. Then you're going to divide the rest over 27 and a half year schedule. So you've got $8,800 from the 27 and a half year depreciation schedule. That gives you your year one total depreciation or deduction of $176,800. Scenario two, no bonus depreciation. And this is just, I'm not going to bore you with this because for speed, I want to keep moving pretty quickly here. But let's just, between the different ways that you can depreciate on the standard without bonus depreciation, you would have likely a first year depreciation of somewhere between 28,000 and 42,000. Let's just call it 35,000 as a midpoint. So 176,000 with the bonus depreciation, 35,000 without. So the pickup that you get by using bonus depreciation in a cost segregation study is an additional $141,000 in depreciation versus not using cost segregation studies and accelerated depreciation. So what does that mean to you from a dollar standpoint? Well, if you're in a 32% tax bracket, that means you have 45,000 less in taxes that you're going to pay. If you're in a 37% tax bracket, 52,000 less. So essentially, that comes up with 10% of your down payment because you're not going to pay the IRS $45,000. You've got an extra $45,000 in capital that you can use for this investment because it's not going to the IRS. Now, there's a carve out here. And let me just reiterate, you need professional advice here. You need it specific to your situation because there's something called a passive loss limitation. So these losses that I'm talking about here, this $176,000 in losses, only offsets passive income, meaning from other passive investments that you have, unless you or your spouse qualifies as a real estate professional status. And that means you have to work on the business of your investment business, and you have to do a certain number of hours. As I recall, it's about 20 hours a week, and it has to be either yours or your spouse's primary business. So for me, I'm in the mortgage business and I earn money in the mortgage business and the rest of my businesses that I own. My wife is a qualified real estate professional. And that doesn't mean she has her real estate license. It just means the designation of a real estate professional is her primary job, and I think it's like at least 20 hours a week, is spent working on our real estate investments. And if we qualify as a real estate professional, then this deduction can be used to offset passive income and active income. The other carve out to be able to use this type of bonus depreciation, if you don't qualify for a real estate professional and you don't have that much passive income to offset, is if you do this on a short-term rental. And there's some rules around that. Again, you need tax advice. I'm just showing you what is possible. These benefits under the One Big Beautiful Bill are so substantial from a tax savings standpoint, it might make sense for you to reorganize what you and your spouse does so that one of you qualifies as a real estate professional to take advantage of these. And again, that's why you have tax strategists like the Tax Hive. You cannot do this without an expert like them. Okay, next, opportunity zones. Opportunity zones are awesome. And there's a lot to this. I tried to break it down into a couple slides. I'll do my best. But opportunity zones enables you to turn capital gains into tax-advantaged growth. So you can roll capital gains from stocks, business sales, Bitcoin sales, property sales into opportunity zone projects. These are designated areas across the United States that if you buy real estate investments in those OZ zones, as they're called, you get a bunch of additional benefits. So let's see the best way to explain this here. Okay, so when you roll capital gains into qualified opportunity investment, the gain on that sale of whatever that asset was is deferred. It becomes taxable on the earliest of one of two events. Either A, the date you sell the opportunity zone investment, or B, year end 2026. So let's say you sold a business in 2025. And you had $1 million of capital gains. and then you bought a property in an opportunity zone. That means you don't have to pay taxes on that $1 million capital gains in 2025. You don't have to pay taxes on that until you file your 2026 taxes, which means that you need to pay those taxes by April 15th, 2027. So it basically buys you another year and rolling the full amount of capital forward into another investment before you have to pay those capital gains taxes. And then I'll show you a way that you can greatly diminish what those taxes would be. All right, I'm going to give you a case study on this to try to drive this home. So let's go through capital gains on a business sold $1 million. You've got federal capital gains 20%, net investment tax 3.8%, state tax 5%. So your total tax bill is about $288,000. If you sold that asset in 2025, you would need to pay the taxes on that by April 2026. Nearly 30% of that gain goes to taxes. Only $712,000 remains to reinvest. But if you invested that money into an opportunity zone, here's what it would look like. You invest that property into the opportunity zone. That buys you another year to pay the capital gains. Then you depreciate the property that you bought in the opportunity zone. So you do a cost segregation study on the new property you buy. Significant portion of that property is eligible for accelerated depreciation. You generate a first year paper loss. So for example, if you had 763 first year deduction from a $3 million property, so you had $1 million, you rolled that into a $3 million property because you took a $2 million mortgage out, that would give you ballpark. I'm just doing a ballpark back of the napkin general analysis for kind of a sample case study here. You would generate about a $763,000 deduction, which means that taxable gain that you have to pay in 2027 reduces from $1 million in capital gains to only $237,000. So I'm just giving you ideas on how you can delay paying taxes on capital gains if you buy in a opportunity zone, and then showing you how you can layer that on top of accelerated depreciation and then use that to offset that $1 million, in capital gains you would have paid taxes on. Then here's the second cool thing about an opportunity zone. If you hold the property for 10 plus years in the opportunity zone, your future appreciation may be federally tax-free. You need to check with your tax advisor. There are covenants around this. You need to understand those at a deeper level. But here's potentially how it would work. You buy a $3 million property because you had $1 million in profit. And I'm just using round numbers to make it easy. Same thing's true if you had a $100,000 gain, you bought a $300,000 property. Let's say that property grows at 4% appreciation over 10 years. That means the property appreciates from $3 million to $4.4 million. And the $1.4 million of new growth, you could avoid federal capital gains tax. So instead of selling the business and only having $712,000 left after taxes, yes, you're going to need to pay some capital gains on this 237, but it's a lot less than paying capital gains on $1 million. Then you roll that into a property that then grows to $4.4 million. Remember, you only owe $2 million on this building. So you've grown that nest egg from $700,000 post-tax to $2.4 million in equity there. And the tax, when you sell the opportunity zone property, can be excluded from capital gains as long as you hold it for 10 years. I know this is a little complicated. I don't expect you to understand everything. I just want you to have ideas that you can go back and talk to your tax advisors about. And this is why the big, beautiful bill has created such an unbelievable tailwind for real estate investors if you understand how to play the game. Like this is the time, in my opinion, to put the pedal to the metal and to think about scaling your investment properties because the tax benefits are so enormous. All right, Section 179. Enables you to write off equipment and vehicles. So instead of depreciating equipment over several years, Section 179 can allow you to expense it in 1 year. There's some limits around that I'll talk about in just a second. So you could invest in business equipment, you could invest in tools, you could invest in technology and certain heavy vehicles. So for example, if you buy a vehicle that has a gross vehicle weight rating, you can find that on the inside door of the driver's side of your car. It'll say GVWR. If that's greater than 6,000 pounds and it's used greater than 50% for business, it qualifies for a much more aggressive deduction on your taxes, kind of like cost segregation and bonus depreciation. You can pull that forward. So if a vehicle is between 6,000 pounds and 14,000 pounds, you can deduct up to $30,500 off of your tax returns in year one if it qualifies. It applies to large SUVs, Escalades, G-Wagons, heavy-duty pickups, cargo vans. And one important note is that SUVs are capped at $30,000 in the first year. If you buy a F-150 or something, then it's not capped at that $30,000. If you buy heavy equipment over 14 or a vehicle over 14,000 pounds, maybe you buy a big dually or something like that, you can have 100% expensing. There's no SUV cap. I don't know if there's any 14,000 pound SUVs out there, but this could be something like a box truck, a large commercial vehicle, heavy duty pickups, a forklift, those types of things. So Section 179, if you're going to reinvest in your real estate business, you may, and your other businesses, you may be eligible for the Section 179. And then lastly, R&D deductions and credits. And yes, real estate investors qualify for this so long as the different things that you invest in fall into the R&D deduction list. So this provides both immediate deductions and potential future credits. Think of internal systems, software systems, upgrades from QuickBooks to Buildium, the automation tools, new service models, construction process improvements. Let me give you a couple of real examples that might register. So stormwater and drainage engineering, structural redesigns for load or seismic requirements. That could be if you're going to renovate or, essentially maybe move something from a single family into a multi-family and add an ADU or something like that. Adaptive reuse conversions. So these are like engineering solutions to convert offices into retail or industrial buildings into residential or mixed use, updating it so that it meets modern coding, high efficiency HVAC and energy modeling. All of these things may qualify for R&D deductions and credits. But obviously, you have to come up with the capital, which we showed you how to do in the first part of this presentation. You have to buy, renovate, remodel, which we showed you how to do without tax returns in the second part of the presentation. And the reason why I layer on this part about tax deductibility is there's never been a more tax-friendly environment for real estate investors than what we have right now. So making sense of doing those things in this environment has never been more advantageous to us. So I gave you a lot of information in 51 minutes. I'm 100% sure you have questions, and we would love to schedule a strategy call with you. So if you're interested in opening up a line of credit, if you're interested in buying an investment property, building an investment property, buy before you sell, if you're interested in any of that stuff, we'd love to chat with you. Feel free to scan the QR code here. I'll also, in just a minute, drop the link to this directly in the chat. I can't do it while I'm screen sharing. But I'll just kind of end on this note. Actually, I'm going to leave that back up so folks have time to scan the QR code if they want. Excuse me, I'm going to put that back up. Okay. So why investors choose to work with Neo? So we understand entrepreneurs because we are entrepreneurs, we are real estate investors, and we work with real estate investors and entrepreneurs every day. We don't look at you through the lens of the traditional, antiquated, old school, conservative, stodgy banking system. We look at you through the full financial picture and provide you a modern mortgage experience. And what I know as an absolute fact as an investor is that none of us get a 2-week advance notice when opportunity is about to come. It's binary. You are either ready and you capitalize on the opportunity, or you're not prepared and you miss the opportunity because you didn't develop a plan before the opportunity presented itself. I would offer that with the tax situation that we have, that friendly tax environment that I described, this is the year of all years to be ready for an opportunity. All right. We've got about 8 minutes left. So, Chris, if it's okay for you, Julie, thank you. This is amazing information. OMG. Thank you, Julie. Really appreciate it. R&D stands for research and development. It's just a part of the tax code that allows you to have more different things that you can write off. Chris, if it's okay with you, I'm just going to pick a few of these questions and answer them unless there's anything you want to jump in here and add, my friend. All right. Very good. So first things first, team, let me drop the link. If any of you want to schedule time with myself and my partner, Ross Zimmerman. Ross, by the way, also has a healthy real estate portfolio, so he is one of us. I just dropped his calendar link into the chat. All right, let me go through a few of these questions. What does shorter life property mean? What are examples? Great question, Martin. Thank you. Okay. So if you actually look at a cost segregation study, the first thing it's going to do is it's going to give you a value for the property, and then it's going to take away the land. So in that example I had, they bought a $400,000 property. They did a $100,000 renovation. So you're into the property $500,000, and then you minus the $80,000 out for land. Then what the cost segregation study does is it literally analyzes each or breaks down each type of equipment inside of that property. So you've got shingles, you've got studs, you've got rain gutters, you've got the studs of your home, you have your foundation, you have your HVAC equipment, you have your appliances, your sheetrock, your carpet, your countertops, your pool, etc., etc. And it breaks out that property, giving each class of property inside of the building a different life expectancy. For example, I happen to know that carpet and flooring is usually a 5-year property. I happen to know that your HVAC and most of your appliances are 7 or 15-year property. So it literally is like a spreadsheet, if you will, where they say land over here, appliances over here, carpet over here. And then they give a life expectancy of each of those building materials. It almost looks like a cost breakdown for anybody who's ever done a construction before. And you kind of see like line item costs of each of the things to build your house. It looks a lot like that. But they assign a economic life span for each of those assets inside the property. And those assets that are 5, 7, and 15-year property, if you qualify and do the tax segregation study and use accelerated depreciation, you can pull all of that forward versus taking the whole house and straight line depreciating it over 27 and a half year. Or if you own your office building, depreciating it over 39 years. So commercial property, 39 years, residential property, 27 and a half years. What an absolutely fantastic question. Thanks for that, Martin. And by the way, guys, there's a fee to that. I'm doing 4 depreciation studies right now. A residential nightly rental on a condo here in Park City, a medical office building, a bar, a brewery. It's called Keto's Brewing here in Salt Lake City, Utah. So we own the building, not the business. And then a small retail center. And so, we've hired a tax segregation specialist to do depreciation schedules. That will yield me almost $2 million in tax deductions. So unless my income is greater than $2 million in 2026, my taxable income is zero, which is the goal. The goal is to get your taxable income to zero. That's why you use these strategies, and that's why you work with the tax hive. Okay, Lisa said, if you all, I lost my train of thought. Sorry, let me finish that thought. There's a cost associated with all those. So the cost on the, and by the way, there's a great tax segregation specialist that I met at the Business Accelerator event that we can get you their contact information. He's doing all these. The cost on the residential condo, I think it's like $1,200. The cost on the commercial properties, anywhere between, I think, $2,500 and $4,500. So they're not free, but if I got a $400,000 tax deduction and it cost me $4,500, sign me up. I'll do that all day long. All right. If you already own the property free and clear, can you do a cash out asset-based loan? Yes, absolutely. So let's say you don't have a first mortgage. What a great question. You can pull a fixed rate mortgage, first mortgage out, and you can have a lump sum access to that money all at once. You can use bank statements. You could, if it's an investment property, you can do debt service coverage ratio, or you can do assets, as you alluded, if you've got significant liquid assets. I don't see a link. Okay, I put the link in, but I actually only have access, Chris, to message hosts and panelists. Can you message the rest of the audience and make sure they have that link, please? And for anybody who's looking for the link, alternatively, you can just scan that QR code right there. Okay, I got some new questions here. These are so good. I don't see the link anywhere. All right, we'll make sure, I'll give you a minute there to use the QR code if you don't see the link. Can you please share the replay of this session? I'm sure that Chris can do that. Is cost segregation only available in the first year a property is placed in service, or can it be performed in later years? Yes, it can be performed in later years. If you already own property, you can do accelerated depreciation. But prior to the One Big Beautiful Bill passing, there was a phase out on the depreciation that you could pull forward. So it started at 100% bonus depreciation, then it went to 80, 60. And so if you bought the property, if you bought it and it went into service prior to January 19th, 2025, you can still do a tax segregation study, but you won't be able to, you might not be able to pull 100% of that bonus depreciation. So the answer is yes, but the amount of depreciation you can pull forward depends when you bought the property and put it into service. Okay. Service. Okay. Is there recapture on accelerated depreciation? Tony, what a phenomenal question. Phenomenal question. Okay. So yes, what you've essentially done is you've taken your basis and you've reduced it significantly because you've depreciated that asset. So for example, I'll just use round numbers. Let's say you bought a $400,000 property and then you sold it for $500,000. Well, you'd have $100,000 in appreciation that you'd pay capital gains on. But if you bought a $400,000 property and then let's say you depreciated it $100,000, so you took $100,000 write-off off your taxes, now your basis is going to be $300,000. So if you sold it for $500,000, now you would owe $200,000 in capital gains. So you would never want to sell that property without 1031 exchanging it. So you'd want a 1031 exchange into another property. That way you skip paying that capital gains. And then my game is I hold those properties until I die, and then my children, through my estate plan, which API law can help all of you set up and you should have in order, then my children or inherit that real estate at what's called a stepped up basis. What's a stepped up basis? Well, if I bought $1 million property and it appreciated to $3 million, so it went up in value $2 million, and then let's say I took out $500,000 in depreciation. Well, then I have all of that difference from what I depreciated to what that value is, that if I sold it, I would owe that capital gains. But when I die and my children inherit it, they get a stepped up basis. And instead of their basis being, I can't remember my scenario, but let's say it was $1.5 million basis. Instead of it being $1.5 million, if when I die, the building's worth $3 million, their basis is not my basis of $1.5 million. Their basis is $3 million. And if they sell that property the day after I die for $3 million, they have no capital gains. Zero money goes to the IRS. So that is the strategy. You buy property, you take accelerated depreciation to offset your income. That gives you a bunch more money to go buy new properties. Then when you sell or scale up, you 1031 exchange until you die. Your kids take the stepped up basis, and then they can do whatever they want later, depending on what your estate plan says. And then they don't pay the capital gains on your basis. They pay it on their basis. So these are the things that you really need to be thinking about. How do I work strategically in concert with tax hive and API law so that I pay little or no taxes, and I structure this so my kids get the stepped up basis and they don't have to pay taxes when I die on all this stuff? Great questions. Thanks for all the interaction. This was a really fun presentation. This is the first time I taught this, so if I stumbled a few times, thank you for being my guinea pigs. I appreciate you very much. On behalf of the Tax Hive and Neo Home Loans, thank you very much for being here tonight. It was a pleasure. And if you have any questions for me, guys, let me give you one other resource, josh@joshmettle.com. Thank you, Julie. Happy to help you. You can email me your questions if you got something for me individually, josh@joshmettle.com. Hope everybody has a wonderful evening, and hope this was super helpful. Take care, everybody.